Welcome to Accounting with Madam Mombi. Today we are going to look at company accounts or accounting for companies. So to begin with, we are going to define what is a company. A company is a form of business whereby several individuals or a group of individuals engage to operate a business. It is a legal entity, meaning that it can sue and be sued in its own name. And also it means that it has artificial life. So a company, once it is formed, then it assumes a legal entity where the members of the people who've come together buying shares, they engage in business either in commerce or industry. There are two types of companies. You can either have private companies. These are companies that cannot invite members of the public to buy their shares. So they are owned individually or by a group of people, but they cannot invite the members of the public to partake or to buy in their shares. Then you have public companies. These are companies that can invite members of the public to buy their shares, and they also can be quoted in a stock exchange. So those are public companies. We can also look at share capital. So in an organization, in a company, the ownership consists of shares. So the share capital is broken down into number of shares. So the share capital is the whole money that is invested in the business in form of shares, and it can be divided into small shares whereby an investor pays for and then is issued with some shares to become an owner. Then we can also look at the form of share capital in a company. The types of share capital are preference share capital and ordinary share capital. And we can begin with preference share capital. Preference share capital carries the right to a final dividend that is usually expressed as a percentage of their value. Now, the first important note about preference share capital is that they have a fixed rate of return. They have a fixed dividend. The dividend is expressed as a percentage. So when you see 10% preference shares, it means that they are going to be paid 10% preference dividend of their total share capital. And this rate of return is constant. And it also means that every year they are going to be paid as per the rate of return. Whether the company is making profit or losses, they still have to be paid their preference dividend. Then preference shares do not vote during the AGM. They do not have a voting right because they do not form part of the ownership of the organization. That is, preference shareholders are not owners. So preference shareholders therefore do not have any control in the company, and they do not have a voting right. The other type of shares is what we call the ordinary share capital. These are the owners of the company. The share capital that is owned by the ordinary the shares that are owned by the ordinary shareholders, they carry a voting right. They are the ones who vote on the issues of the company during the AGM, but they do not have a fixed rate of dividend. What they are entitled to is what we call residual value. So at the end of the year, the ordinary shareholders receive dividend as per the discretion of management. So management or the board of directors, they decide how much ordinary shares will get or will be awarded as dividend. At the time of liquidation, if a company has gotten to its end, it has to be liquidated, ordinary share capitals are paid last. They are entitled again to residual value in the fact that after you have paid all the claims of the creditors, paid all the claims of the preference shareholders, then the ordinary shareholders are the last to be paid, or their claims are the last to be settled in the time of winding up. But most importantly, what is there to note about ordinary share capital is that it is the higher the number of ordinary share capital held by an individual or an organization in a company, the higher the control. So those who are majority shareholders, they end up having higher control of the organization because they have even more voting rights. So the ordinary shareholders are actually the owners of the organization. That is a form of share capital, which is ordinary share capital. Now we can also look at how shares are issued. Issuing of shares in an organization. So when you're going to be issuing the ordinary share capital, you can either issue the shares at par. The par value is the face value. So for example, you can issue 10,000 shares at shillings 10 each. The shillings 10 each is what you call the par value. Sometimes you may also issue the shares at more than their par value. So as we have said, if a share's par value is 10 shillings and you issue the share at 15 shillings, you have issued the shares at a premium. The premium here being the 5 shillings above the par value. So for every share, the 5 shillings above the par value is what we are going to be calling a premium. So shares can be issued either at par or they can be issued at a premium. Even when they're issued at a premium, the par value will be computed separately and it is going to be contained in the ordinary share capital account, and the share premium will be computed differently and will be contained in the share premium account. So that is it about the issue of shares. You can also look at company reserves. What are company reserves? These are amounts that have been kept aside by the organization, either to meet future investments or to meet future dividend payouts or to make and meet future obligations. Now, the reserves can be broken down again, or they can be classified into two. You have what you call capital reserves. These cannot be distributed to shareholders. One of them is what we have called the share premium, where we have said shares have been issued at more than their par value, resulting in a premium that is kept in the share premium account. You have revaluation reserve, where fixed assets or non-current assets are revalued and the revaluation gain is kept in the revaluation reserve. And you can also have capital redemption reserve, which are reserves that have been kept aside for redemption of shares, especially where you have preference shares that are redeemable. So at the time of redemption of the preference shares, you're going to require some funds from the capital redemption reserve. So these are capital reserves. Another type of reserves you can have is revenue reserves. Revenue reserves can be distributed to shareholders in form of dividends, and they include the general reserves and the profit and loss account, which is the retained earnings, or the retained earnings accumulated into one account. And we are saying from these reserves, then dividends can be paid to shareholders. So that is it about the company reserves. Of importance in our class today, before we dive into computing some company accounts, we want to look at some of the key and unique items that you are likely to find in company accounts. When I say unique items, it's because we have not found them in sole proprietorship when we accounted for a sole proprietor. It is also because we did not find them in partnership accounts when we accounted for partnership. So they are unique to company accounts. And those items, number one is debenture loans. So companies can borrow in form of loan stocks, where they are issued with a certificate for a loan stock, and which we commonly call debenture loans. Those are not common amongst partnerships and sole proprietorships, but they are there in a company, the debenture loans. And they are loans of high amounts of money. And then these loans attract a debenture interest, which is a finance cost. Definitely, once you borrow, then you have to pay interest on the borrowed amount. So we are going to find that in companies, mostly you're going to find there is debentures, which is also accompanied by debenture interest, or the interest on the loans. We are also going to find that in companies, there are director salaries. Now you're going to remember here that we have said a company is managed by a board of directors. And the board of directors require to be remunerated. And their remunerations is no mean amount, it is a substantial amount of remuneration. So unlike sole proprietorships that are managed by the owner, unlike partnerships that are managed by the partners, companies are managed by a board of directors who are entitled to a director's salaries and remunerations, and these are going to form part of the expenses of the companies. Again, you have audit fees. All public companies have to be statutorily required to be, they have a statutory requirement to be audited. All public limited companies have a statutory duty to be audited. And definitely, the external auditors who come to the organization have to be paid some audit fees. And that is what is reflected here again, another expense, which is called audit fees. And again, comparing that with sole proprietorships and partnerships, which do not have a mandatory requirement to be audited, then they may not have audit fees for the first two forms of businesses that we have looked at. Then you can have corporation tax. Having said that a company is a legal entity that can sue and be sued in its own name, it also operates business in its own name, it also pays tax in its own name. So every corporation pays a corporation tax at the predetermined tax rate in the country or in a certain tax zone. So corporation tax, again, unlike partnerships and sole proprietors where the owners individually pay for the tax of the business, for companies they pay their own tax in their own name as a legal entity. Finally, the other last part or the unique items in a company account is the dividends. Having two types of shareholders here, who are the preference shareholders and the ordinary shareholders, at the end of the year, and also maybe halfway through the year, these shareholders have to be compensated or rewarded for their investment in the company by being paid what we call dividends. So dividends is a payout from the organization or from the company to the shareholders. It is a form of reward to the shareholders, and the dividends can be paid either in the interim dividends usually are paid mostly half of the year after 6 months, and we can have the final proposed dividends, which are the dividends that are proposed at the end of the year. So all these unique items shall form part of the items you are going to find in company accounts that are not found in sole proprietorships and partnerships. So henceforth, we are going to look at how now our major interest is to prepare the income statement and the statement of financial position for a company. And to do so, we need to look at the format. So we have the format here of the statement of income. It is not very different from the statement of income that we have prepared previously and the other forms of businesses, because the format is actually the same. We are going to begin with the sales. You have then the cost of sales. The cost of sales is still made up of the same items: opening stock, you add purchases, you add carriage inwards, you less return outwards, and then you get the cost, the goods available for sale, you less closing stock, and all that figure which is called cost of sales. Once you subtract from the sales figure, you are able to get the gross profit. We are going to add other incomes. The other incomes like investment income, discount received, etc., to get the total income. After which we are going to less the expenses for the period. And the expenses here we can see they are classified in broad categories like administrative expenses, selling and distribution expenses, audit fees, directors' remunerations, insurance, and so on. Once you have list all the expenses, you are going to get the net profit before interest and tax. So at this point, we have not yet subtracted the debenture interest. After which we are going to subtract the debenture interest, which is represented there as finance cost, and get the profit before tax. After which again we are going to consider the corporation tax. So we are going to subtract the corporation tax and get the profit after tax. Once we have the profit after tax, we are going to add the retained earnings from the previous period. That is the retained profit from the beginning of the year. And then we are going to have an appropriation where we transfer any money to the general reserve as advised, write off preliminary expenses, and finally we are going to pay the dividends both to the preference shareholders and to the ordinary shareholders. And whatever we have remaining in this account shall be the retained profits carried down. And that is it for our statement of income. We can also look at the statement of financial position or the balance sheet. So again, the balance sheet is prepared the same way that we have prepared previously, whereby a balance sheet is prepared or a statement of financial position is prepared to show the worth of the business in terms of how much assets and how much financing the business and how it is financed. So we are going to start with the non-current assets. You may follow any other format as prescribed in your jurisdiction, but we are going to follow this one, non-current assets, where we are going to account for their cost, their depreciation, and their net book value. Then you are going to note that companies have a lot of intangible assets, assets that cannot be touched, like investments, goodwill, softwares, patents, copyrights. And because companies have all those intangible assets, they are also going to get their own classification. And finally, among the assets, we are going to look at the current assets. After which we will get the total assets of the organization. And in the financed by section, we are going to look at the equity and liabilities, starting with the shareholders' funds, which is represented by the ordinary shares, preference share capital, capital reserves, share premium, revaluation reserves, general reserve, retained profit, and the proposed dividend that has not been paid. For the proposed dividend, we have an option to classify it under shareholders' funds, or we can also classify the proposed dividend under current liabilities. And we are going to see about that in our question. Then finally, you have the current liabilities and the non-current liabilities. Majorly, our non-current liabilities include the loan stocks or the debentures. And this is how we are going to prepare the statement of financial position. Now, to be able to achieve this, we can go ahead and look at a question. So we are going to be looking at a question here that says that Mapato Limited has provided the following information for the year ended June 2018. So the information provided is that issued ordinary share capital, which is of shillings 10 each, as at 1st July 2017 is 100,000. From that information, we are going to compute the number of ordinary shares. Then you have 10% preference share capital, which is 50,000. Again, we said the 10% represent the rate of dividend. So the preference dividend is going to be 10%. You have share premium. You have 10% debentures, which means 10% debentures means that the debenture interest is going to be 10% of 30,000. That is the debenture interest. We have retained earnings, general reserve, freehold land, which is an asset, plant and equipment, an asset, motor vehicle, at cost, an asset. We have goodwill, an intangible asset, trade receivables, current asset, bank, current asset, trade payables, current liabilities, revenue, cost of sales, distribution costs, and so on. So we are going to compute this question as we have seen in part 2 of the video. So watch out for part 2 of company accounts, where you're going to learn on how to compute the income statement and also the statement of financial position. So if you have found this to be helpful, kindly like, share, and subscribe. Thank you.